How's it going, guys? Chris here. Today we're going to be watching Renting versus Buying a Home. What people get wrong. So this is going to be about what actually is better off for you in the long run, renting or buying. For most people, technically probably renting is better. However, for most people, buying a house, I believe you're better off because at the end of the day, at least when you retire, you have like this house that you don't one have to pay rent for, and two, it's yours. So that's pretty cool. So it means you can retire on less of an income if you own your own house. Now let's get into it.
Real quick before I start, I will never send you an email, and definitely not from a Gmail address, that it is. That article received hundreds of comments from readers, many of them exemplary of what people get wrong about the rent versus own decision for housing. People tend to assume that homes are great investments. They're not. That mortgages are a wealth building hack. They help, but not as much as people think. That paying off a mortgage lowers your housing costs. It actually raises them. And that owning a home makes people happy. It might, but don't count on it. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you what people get wrong about the rent versus own decision for housing. Of rent. A mortgage payment is not the cost of living in a home.
Also, by the way, the full video link will be in the description below if you'd rather watch that without my commentary.
I hope that will become clear as we proceed through the video. Homes are generally terrible investments, yet a lot of people believe that they could not have found a better investment. One reason is salience bias, the tendency to focus on information that stands out, whether due to its prominence, emotional impact, or vividness, often at the expense of other less noticeable or less emotionally charged details. Buying a home is a big emotionally charged purchase, and the final price is likely the result of emotional negotiations with a seller. The same goes for selling a home. This leads people to focus on those two numbers, how much they bought the home for and how much they sold it for. If you bought a home for $40,000 in 1974, did some upsizing, and eventually sold for $2 million in 2024, you would probably feel pretty good about the decision. But there are two big problems with this evaluation. One is that compounding is hard to think about. 50 years is a long time. The compound average growth rate to get from $40,000 to $2 million over this period is 8.2%. Don't get me wrong, that is a great return. This example does come from Vancouver after all, and from a comment on the internet from an anonymous person arguing that owning a home is great. I did find an example of a home in Vancouver that listed for $51,900 in 1974 and sold for $1.65 million in 2024. That lowers the compound growth rate to 7.16%. Still great.
Yeah, I don't know. In Australia, it's insane the growth that houses have seen. Like especially in the last 5 years, they've doubled easily, and unlike other places in the world, they haven't come down. Right, they've stayed high. It's insane.
But here's some context. Over that period, the MSCI World Index, an index representing the global stock market, returned 10.2% annualized in Canadian dollars, and the TSX, an index representing the Canadian stock market, returned 9.44%. Clearly, homes are not the only way to compound wealth, even in a market like Vancouver. It is important to reiterate that Vancouver is an extreme example. The returns to housing in Canada and around the world are generally lower. The price return on housing Canada-wide from 1974 through 2024 was 6% before inflation, and inflation ran at 3.76% annualized over that period, meaning a real housing return of a little over 2%. Data from around the world going as far back as 1870 show inflation-adjusted returns to owned homes as a little over 1 percentage point on average, while stocks have outpaced inflation by about 5 percentage points. The economic reality is that homeowners bear the cost of having their money invested in a lower expected return home rather than higher expected return stocks. This is called an opportunity cost. To be conservative, I think 3% is a reasonable figure to use as the opportunity cost of having money invested in a home rather than in stocks. The other issue is that the salience by
Yeah. In Australia, there's a big FOMO of getting into the housing market. Like even I come under it. Like, but it's just becoming so ridiculous for especially young people like myself to get into a house. You're looking at, you need like 100 grand deposit, and then you need to pay that like $1,000 and pretty much a minimum a week for 30 years. So the opportunity cost is pretty high here in Australia. Like obviously, yes, there are, um, that there are houses that go up crazy amounts, and they continue to go up in insane amounts, and they probably will continue. However, the stock market, the Australian stock market hasn't done too bad, but you look at like the US market, potentially you could make more just from investing in that. So it's hard to justify, especially when, if you buy a house, it's definitely an emotional decision. It's not, it's semi financial. Like if you go into the mindset, oh, this is 100% a financial decision, then you're kidding yourself, right? But yeah, I don't know. Like there are some benefits to buying a house that are less financial. It's more tangible than that. Like you can build roots for your family and whatever.
Hides the total costs of owning a home. If you buy a house for $51,900 and then sell it for $1.65 million many years later, your return on that asset is not the 7.16% compound growth rate. The reason is simple. Owning a home costs a lot of money. Between regular maintenance spending to keep the house running, spending to make up for depreciation of the building like the roof deteriorating, renovation spending to improve and update the home, which many people do, and property taxes, it's not uncommon for people to spend 2 to 3% of the home value per year on average just to live there. A good example is that 1974 listing that I found. It was completely rebuilt in 2012 before selling for $1.65 million in 2024. The rundown 1974 structure would be unlikely to have sold for the same price. Homes are depreciating assets. People get really upset when I say that, but it's true. Land appreciates. Homes, buildings degrade and decline until in many cases being torn down and rebuilt. Those depreciation, maintenance, and renovation costs need to be included in the calculation of the return on the home. People that disagree with that 2 to 3% per year number have probably never owned a home. But I didn't just make that number up either. Academic research and data from Statistics Canada support figures in that range.
Yeah, see, I've never owned a home, but from listening to my parents speak, like they own their own home, and yeah, you can tell that there are a lot of expenses, and stuff isn't cheap, right? Like you'd be forking out like some weeks, a couple grand to fix stuff. Like if a toilet breaks, fucking pipe bursts, I don't know. Like there's so many things that could go wrong in a house, and the good old saying of a mortgage is the minimum you'll pay is very true, while rent is the max you'll pay. Like when you rent, you don't have any expenses. It's good for a lifestyle if you don't plan on staying in one place for a long time. Renting is the way to go. It's pretty shitty, but at the end of the day, it is better.
I'll link sources in the episode description. For one example, in National Accounts data, Statistics Canada reports average maintenance and repair costs of 0.81% as a proportion of net residential housing stock over the last 50 years, and renovation spending of 2.35%. This implies that there is more than a 3% average annual contribution to the average increases in home values that can be attributed to costs incurred by homeowners. Even if we take the lower end, 2%, removing that from 7.16% results in a return of 5.16% for this Vancouver home. There are, of course, costs to invest in stocks too, but they're typically much lower than 2 to 3% per year as long as you're not investing in the highest fee actively managed mutual funds or segregated funds. Renters do also need to cover their housing costs since you can't live in your tax-free savings account. The interesting thing here is that when you add up all the costs of living in an owned home, the ongoing maintenance, depreciation, renovation costs, property taxes, and the opportunity cost of investing in a home rather than stocks, you typically end up with a number pretty close to what you would pay in rent. Take 2% in estimated ongoing costs and a 3% opportunity cost for having money in a home rather than in stocks. That is 5%. With these numbers, theoretically, rent should cost around 5% of the value of a home. If either renting or owning were materially more expensive overall, it would be reasonable to expect people to shift between the two options until their costs converge. If rent is cheap, more people will switch to renting, up until the point where rent stops being cheap. The interesting thing is that this ends up being a pretty good model for rents in Canada. The national average price for buying an apartment in Canada in March 2025 was $512,300. Multiplied by 5% and divided by 12 to get a monthly number, we get $2,134 as the implicit cost of owning the average apartment in Canada. The national average rent for apartments is $2,119, almost identical to what my simple model here predicts. This means that in this example, you are approximately financially indifferent between renting and owning the average apartment in Canada. The math doesn't always work out like this, but this thinking lets you gauge whether owning or renting is relatively cheap or expensive. For a long-term perspective, including the effects of mortgage debt, which I'll come back to shortly, you can use the free rent versus own calculator on PWL Capital's website. I used national average data here, but you can plug in numbers for your specific city to compare projected outcomes. In some cases, rent might look cheap, and in some cases, it might look expensive. I should say a few words about how this model works. It is comparing the long-term outcome of buying a home to the counterfactual outcome of renting. In the first year of the model, the owner buys a home. They pay a down payment and closing costs. The renter instead invests the down payment and closing costs in a portfolio of stocks and then pays rent, which increases 1% per year above inflation in the model. The total cash flow costs of owning a home, including property taxes, maintenance costs, and mortgage payments, are assumed to be the total cash flows available to both the renter and owner. If rent costs less than the owner's cash flow costs, the renter is saving and investing the difference into a portfolio of stocks. If rent costs more than the cash flow costs of owning, a common scenario with the mortgage paid off, the renter funds the cash flow shortfall from their portfolio. This scenario assumes that the renter is investing in their RSP, TFSA, and FHSA, which are not taxable, but I will come back to the implications of taxable investing later. To come back to the main points on home ownership not being such a great investment, salience bias leads people to focus on what they bought their home for and what they sold for, ignoring the ongoing costs of living in the home, and especially at long horizons, overestimating the compound return.
See, normally you hear that, if you're long term in a house over like 7 to 10 years, you're actually better off. Well, you're not better off, but it's more financially sound because you're spreading those large sum in terms of opening and closing costs or buying and closing costs. Your renovation costs, all those sort of costs are spread out over a longer period of time. However, I guess also in that same period, you'll have a higher chance of having higher maintenance because likely stuff will go wrong, right?
On their home. Properly accounted for, the returns to housing are typically not special, and similar financial outcomes can be achieved by renting and investing in stocks. There are multiple academic studies based on Canadian and US data showing this to be true. Let's move on to the value of mortgage debt. I'll come back to forced savings and tax treatment later. Mortgage financing is one of the most favorable forms of financing available to most people. It is generally low cost and does not get called when the home value drops, like a margin loan for stocks can. Borrowing early in life to get exposure to assets is arguably a good thing, and mortgage debt is a great way to do that. It's also a double-edged sword. Many people in Canada were squeezed financially when mortgage rates increased after the pandemic.
Yeah. First, well, home ownership regret is crazy high at the moment, especially when, like, in Australia, you can't have 30-year fixed mortgages. If that was the case, there wouldn't be too much stress. But we can only have, like, I think it's 2 to 5 years, whatever it is. Come down below what it is, I don't know. I don't have a mortgage. But yeah, so when your mortgage jumps up, $1,000 to $2,000 a month, you can that does squeeze people just a little bit, right?
And they can be a burden if your property value declines and you want to move. The main point I want to make here, though, is that a mortgage is not a silver bullet for owners to build more wealth than renters. Take an example where a home is bought in cash by a homeowner. The counterfactual renter invests the cost of buying the home, in this case the full price of the home plus closing costs, in stocks, and then pays rent. The owner doesn't have a mortgage, but they do still have some costs like maintenance costs and property tax, but their cash flow costs are much lower than the renters, meaning the renter in the model has to draw from their portfolio to cover the difference. The thing is, the expected returns on the renter's investment portfolio are more than enough to make up for the difference. The owner is paying a large implicit cost by having so much home equity relative to the renter's large stock portfolio. After 50 years, the renter's wealth exceeds the owner's by $2.2 million. Next, consider the same case, but instead of paying...
That's a pretty scary comparison, right?
In cash, the owner puts down a 20% down payment and finances the remainder of the purchase with a mortgage. Now, the owner has large cash flow costs because in addition to property taxes and maintenance, they have a mortgage payment. The renter initially invests the smaller down payment into a stock portfolio and then saves the monthly difference between the owner's higher ongoing cash flow costs and their rent into an investment portfolio. The net worth difference after 50 years in this case is $467,000. Financing with a mortgage was more financially advantageous for the owner than paying cash.
Yeah, at the end of the day, it's just a leverage equation, right? So the more leverage you can take on in this, like obviously there's risk with taking on debt, but it allows you to get more cash on cash returns. So it's it's a double-edged sword, right? Like when I think about buying a house, right, I want to buy a house, get a 30-year mortgage and pay it off in like 10 years. However, in terms of like the cash flow strain that will cause me, it's actually not worth it. But psychologically, you think, well, you're paying off your mortgage, you're becoming debt free. How's that a bad thing? But technically, mathematically, it's actually a bad thing because you should be investing that extra surplus that you have into something that can give you 10% return instead of bringing down your debt by 5%, for example.
But the renter was still able to come out ahead without borrowing any money. The owner's relatively high cash flow costs allowed the renter to save more into their higher expected return portfolio, all else equal. The next misunderstanding I want to cover is that people who own homes are wealthy because they own homes. It is true that the average net worth of a homeowner is significantly higher than that of a renter, both in Canada and the United States. But this is not because owning a home is an automatic path to wealth. Renters tend to be younger, have lower incomes, and spend more of their incomes on housing costs, making building wealth by any means more of a challenge. Buying a home would not...
I think also just when you're a homeowner, you sort of have a forced savings, so you're building a bit of wealth in that sense. And I guess it's probably a bit stereotype. Like obviously for older people, younger people that are still renting, there's obviously a lot of pressures in terms of being able to afford one. But like older people that are, maybe in their 50s, 60s, correct me if I'm wrong in the comments down below, but they were not wise enough, or they've maybe had divorce or whatever, to not buy a house, so their wealth has been sort of splurged along the way, I guess you can say.
Let's solve these problems, and some research shows that homeownership can actually negatively impact the happiness of low-income households due to the financial burden of homeownership. A 2017 paper, A Revision of the American Dream of Homeownership.
I mean, stressing about a mortgage payment every friggin' week it's pretty stressful, especially if you got to pay like $1,000 for a mortgage payment. That's every week that would be stressful.
Seeks to answer the question of why owner households tend to be wealthier than renters. The authors find that it can be attributed to choices within the scope of the individual, like how much the renter saves, rather than through the impact of exogenous market variables like housing or stock market returns. They show that households that fail to reinvest the cash flow difference between renting and owning accumulate less wealth. And importantly, they find that property appreciation plays only a minor role in the results for homeowner and renter wealth differentials. This analysis shows, as I have already said, that renting and owning can theoretically have similar financial outcomes, but this requires...
I think we'll end it here. If you guys want to watch the rest of the video, make sure to click it down below. But at the end of the day, yeah, if you can be frugal when you're renting and, be diligent and invest, you're going to be just as well off. So for a lot of Australians that are struggling to get into a house, I guess this is a sigh of relief, that you could, instead of stressing about buying a house that's like $1 million, you should just be focusing on investing and getting along with your life and focusing on other things other than just a house. Or alternatively, you move to a different state or whatever, like so many people already have done. Anyway, if you guys enjoyed, make sure to like, comment, and subscribe, and I'll catch you in the next one.